If you trade Forex, you don't need anybody to tell you that many of the popular currency pairs are in conditions at this time that can be pretty tough to trade. Sure, you can emotionally trade them, and maybe you're going to get a winner. But for the past little while, finding great reasons to trade really haven't existed. There's been some choppy price action, low volatility, momentum appearing and then disappearing, and all of that combined does not make our jobs any easier. And there is a telltale sign that conditions are not great. And for that, we can look at the US dollar index. For those of you that are unaware, the US dollar index measures the US dollar against 6 other currencies. Inside of that basket, the Euro US dollar makes up the bulk of the measure. And the top 3 currency pairs inside the basket are the Euro, the Yen, and the British Pound. Those currencies are matched up against the US dollar, and they form the bulk of the trading activity that happens in Forex. The dollar index is a pretty good barometer of the strength or the weakness of the US dollar against other pairs, although the trade weighted index, it's argued, could be more relevant to the strength of the US dollar. So adding the knowledge of technical analysis of the dollar index can be a part of your overall trading plan and help you assess which direction that you want to trade. This US dollar index chart shows that from the beginning of the year, the US dollar was weak against the basket of currency pairs. The price action trend pattern is showing lower highs and lower lows. You can also see that any price consolidations resolved to the downside. And if you bring up the euro or the pound against the US dollar, you're going to see that the drop in the US dollar index coincided with an uptrend in those pairs. And there were some pretty good trading opportunities regardless of your approach, unless you were picking tops, of course, and price was trending pretty good. Well, the weather shifted in early February. Upside momentum stepped in, showing the US dollar getting stronger as price began to rally. And if price would have kept moving, trading conditions would have continued to be pretty decent, but markets are never affected by what we want. And if you're familiar with any sort of technical analysis, trending markets make a stair-stepping pattern. But as you can see in the index, price sold off, it failed to make a lower low, and it got trapped between the extremes. And this is when trading Forex or any other market becomes just a little more difficult. When the higher time frames are trapped between 2 extremes, lower time frame charts usually have some trending moves that you can trade. But for longer time frame traders like myself, while that first rally back to resistance was a good trade, the wheels came off of the market, especially for those of us who focus on the trend. The market was still in an uptrend mode on the higher time frames, but the larger range with the range inside of that range made the price moves less reliable. Now, hindsight on this chart is really easy, but trading the hard right edge would not have been smooth like you would have traded hypothetically. And I don't use much in the way of trading indicators, but using an intermediate term moving average, it can give you an indication of trading conditions. This is just a 20-period EMA, and the green star indicates when the Euro US dollar put in a double top, not long after the US dollar index on this chart put in a double bottom. Price begins to whip around the moving average, and that indicates the price is in a relative balance at this point. Markets that are in balance are tough to trade regardless of your trading experience. And while you can see the same thing with price action, using an indicator in this way allows you more objectivity, and it also helps you quickly scan charts that are worthy of your attention and your risk. And if you look at the Euro US dollar with the 20 EMA applied, we can see the exact same condition. Once price starts whipping around the moving average, much like the dollar index, stepping aside until the consolidation resolves is generally the better option. And you could trade the lower time frames, but for longer term traders, that would be an entire shift in the business plan. So if you look at the US dollar around the end of March, although we've seen some movement to the downside out of the smaller trading range, we still had lows less than $1 away. So does the recent strong move in various currencies mean the consolidation's over? Well, maybe not. When markets are in consolidation, sudden momentum bursts are not uncommon, and oftentimes prices will simply fall back into the trading range, and we can never know with 100% certainty what the market's going to do. And we can plan for different outcomes, and we can react when price reaches the zones that may be considered a tipping point, such as the high or the low of a trading range. Combining the resolution of the Euro US dollar, the pound US, and the US dollar against the Japanese yen with the resolution of the dollar index gives you a double whammy approach to trading the top three crosses.